Bitcoin's white paper describes it as a peer-to-peer electronic cash system immune to government monetary debasement. Its most enthusiastic proponents call it digital gold, a store of value that will hold its purchasing power precisely when fiat currencies are inflated away during fiscal and monetary crises. But when the COVID panic hit markets in March 2020, Bitcoin fell 50% in 48 hours, faster and harder than the S&P 500. When the Federal Reserve hiked rates aggressively in 2022, Bitcoin lost 75% of its value alongside the Nasdaq. The correlation data is clear. Historically, crypto has behaved like a high beta risk asset, not a safe haven, during acute market stress events. But the story is evolving. In late 2024 and 2025, Bitcoin showed signs of decoupling from tech stocks in specific macro environments. Understanding the conditions under which crypto acts as a hedge versus an amplifier is one of the most important questions in institutional portfolio construction today. The safe haven debate around crypto hinges on a precise definition of what a safe haven actually is. In academic finance, a safe haven is an asset that maintains or increases its value during periods of market stress, specifically when equities are declining sharply. Gold is the canonical safe haven. It has a negative or near zero correlation with equities during recessions and acute risk-off events. Bitcoin's theoretical case for safe haven status rests on three pillars: fixed supply of 21 million coins, censorship resistance, and immunity to monetary debasement. The empirical case, however, is weaker. Bitcoin's 90-day rolling correlation with the Nasdaq has averaged 0.6 to 0.7 over the past 3 years, a meaningfully positive relationship that means Bitcoin tends to decline when tech stocks decline. The honest institutional answer is that Bitcoin behaves like a risk asset with safe haven narratives, not a proven safe haven with risk asset characteristics. The empirical data on Bitcoin's recession behavior is sobering for the safe haven thesis. In the COVID crash of March 2020, Bitcoin fell 50% versus the S&P 500's 34% peak-to-trough decline. In the 2022 Fed tightening cycle, a classic risk-off environment for growth assets, Bitcoin fell 75% from peak versus the Nasdaq's 35% drawdown. Bitcoin's beta to the S&P 500 over the 2020 to 2024 period measured approximately 1.4 to 1.8, meaning it amplified equity drawdowns rather than hedging them. The nuanced data point: in late 2024, during a period of dollar weakness and inflation re-acceleration, Bitcoin's 60-day correlation with gold rose to 0.45, its highest reading in the asset's history. That single episode suggests the safe haven narrative may strengthen as Bitcoin's ownership base matures and institutionalizes. The safe haven question forces a comparison between two distinct recession scenarios and crypto's expected behavior in each. In a deflationary recession, characterized by falling asset prices, rising unemployment, and risk-off sentiment, historical data strongly suggests Bitcoin will decline alongside equities, acting as a high beta risk asset that amplifies losses. Institutional allocators holding crypto in this environment experience negative diversification benefit precisely when they need it most. In an inflationary recession, characterized by rising prices, currency debasement, and fiscal stress, Bitcoin's theoretical safe haven properties may be more relevant. The 2024 episode of dollar weakness and inflation re-acceleration provided early evidence that Bitcoin can decorrelate from equities when the primary stress driver is monetary rather than credit-based. This distinction has direct implications for how institutions should think about sizing crypto as a portfolio hedge. Institutions holding crypto with safe haven expectations face three distinct risk categories. First is correlation breakdown risk. If an institution sizes crypto as a recession hedge based on the gold analogy and experiences the COVID scenario instead, crypto falling 50% alongside equities, the allocation amplifies losses at the worst possible time. Second is liquidity risk. During acute market stress, crypto exchanges can experience technical failures, withdrawal halts, or extreme bid-ask spreads that prevent timely exit. Third is narrative risk. The safe haven thesis is largely driven by community narrative rather than fundamental cash flow analysis. If institutional sentiment shifts, as it did in 2022, the narrative premium collapses and safe haven properties disappear instantaneously. The March 2020 COVID crash provides the clearest case study for evaluating crypto's recession behavior under acute stress. On March 12, 2020, Black Thursday, Bitcoin fell from approximately $7,900 to $3,800 in under 24 hours, a 52% intraday decline. The mechanism was straightforward. As leveraged traders across all asset classes faced margin calls, they sold whatever was liquid first. Bitcoin, with deep 24/7 liquidity, was sold immediately. Gold, which requires physical delivery and has lower leverage, held its value much better. The episode was a textbook demonstration that Bitcoin in 2020 behaved as a high beta risk asset in the institutional liquidity cascade, not as a safe haven. It also revealed that Bitcoin's 24/7 liquidity, often cited as an advantage, becomes a liability during panics because it's the first asset sold by leveraged holders facing margin calls. Institutions that want to incorporate crypto in a portfolio with recession awareness need a framework that accounts for the type of recession expected, the correlation environment, and the sizing implications. Step 1 is recession type mapping. Identify whether the primary macro risk is deflationary credit stress or inflationary fiscal stress, as crypto's behavior differs meaningfully between these scenarios. Step 2 is correlation monitoring. Track Bitcoin's rolling 90-day correlation with the S&P 500 gold. When Bitcoin gold correlation rises and Bitcoin equity correlation falls, the safe haven thesis is empirically stronger. Step 3 is size accordingly. If crypto is sized as a diversifier, not a hedge, the position should reflect its actual correlation profile, not a theoretical safe haven narrative. Step 4 is liquidity stress testing. Model exit scenarios during acute market stress and confirm that position size is executable at target prices even with wide spreads. 3 institutional mistakes define poor crypto as hedge positioning. First, oversizing crypto based on the gold analogy without verifying that Bitcoin actually behaves like gold in stress scenarios. It historically has not. Second, ignoring the leverage-driven correlation spike. During any acute deleveraging event, correlations across all risky assets spike toward 1.0, and Bitcoin is no exception. Diversification benefits disappear exactly when they most need it. Third, holding crypto on exchanges during market stress. Exchange custodial risk and withdrawal halts mean that institutional holdings should be in segregated custody with verified withdrawal infrastructure before a crisis, not during one. Crypto's recession role is evolving but not yet established. The honest institutional answer in 2026 is that Bitcoin behaves as a high beta risk asset during deflationary stress and shows early signs of safe haven behavior during inflationary stress. Size it accordingly, as a diversifier with asymmetric upside potential, not as a portfolio hedge that reduces drawdowns during equity bear markets. The safe haven debate is one of the most consequential questions in institutional crypto portfolio construction. The data is nuanced, and getting the sizing right requires understanding both scenarios. Subscribe to Crypto Mechanics for institutional-grade crypto analysis delivered weekly.